Good morning, everyone. This is Sakis Paraskevov, Senior Fundamental Analyst at IronFX Global, bringing you the morning comment for the 17th of December. Fed hike rates ends zero-rate era. The FOMC unanimously voted to increase the target range of the federal funds rate by 25 basis points and emphasized that the future hikes will be gradual. In the press conference following the decision, Fed Chair Yellen said that the Fed's decision totally reflects our confidence in the U.S. economy. This signals that the U.S. economy has largely overcome the wounds of the financial crisis and is expected to continue to perform well. In the statement accompanying the decision, the committee acknowledged the considerable improvements in the labor market conditions and expects inflation to return to 2% as transitory effects of declines in energy prices fade away. The path of future policy will be determined by incoming data from the labor market and signs of inflationary pressures and inflation expectations. Overall, Fed officials expect that economic conditions will evolve in a manner that only warrants gradual increases in the Fed funds rate. The dot plot median projections for 2016 were unchanged, showing that Fed officials still expect around 4 hikes next year. Although the pace of increases expected by the committee is slower compared to earlier cycles of Fed rate increases, it is faster than what the market was pricing ahead of the meeting. As a result, the dollar regained some of its lost glamour and strengthened against its major peers. We will continue to closely monitor U.S. economic data and especially inflation data, as they will determine the course of how gradually next hikes will occur. As for today, during the European Day, the main event will be the Norges Bank monetary policy meeting. The recent tumble in oil prices is slowing Norway's oil and gas investments, which could put pressure on the bank to act again. Nevertheless, inflation accelerated in November and currently lies above the bank's 2.5% target. Thus, lowering the key interest rate further could be difficult to justify. In its latest monetary policy report, the bank indicated that the depreciation of NOK should be seen with connection to declining oil prices and that a weak currency contributes to higher inflation and economic activity. They noted that this pushes up the path for the key policy rate, and therefore we expect the bank to remain on hold at this meeting despite the plunge in oil prices. Additionally, the statement accompanying the decision will be closely monitored by market participants, as it is expected to indicate a dovish stance and could weaken Norwegian krone further. It could also provide strong signals regarding the bank's likelihood to ease further in March. EU leaders will meet in Brussels to hold their final 2-day summit of 2015, which will focus on the migrant crisis, the terrorism threat, and measures to boost the continent's single market, as well as the British referendum on EU membership. The UK Prime Minister David Cameron has pushed a set of suggestions for EU reform, which he would like to be high on the agenda of discussion. A failure to meet Prime Minister Cameron's request could increase the likelihood of a Brexit in the referendum to be held in 2017 and put further selling pressure on GBP. As for indicators, the German IFO survey for December is due to be released. The forecast is for the Business Climate Index to remain unchanged, while the Expectations Index to tick up a bit. The forecast is somewhat in line with the ZUW survey for the same month, which showed that the outlook for the German economy shows signs of improvement. Therefore, we see a possibility for a positive surprise in the IFO indices as well. This could support the Eurozone's common currency a bit. In the UK, the retail sales excluding volatile items for November are due to be released. Expectations are for a 0.6% increase, a turnaround from minus 0.9% in the previous month. A rebound in the figure could indicate growing demand in the final quarter of the year, and following a mixed employment report on Wednesday, a strong retail sales figure is needed for the British pound to regain some steam. From the US, we get initial jobless claims for the week ended 11th of December. Even though the forecast is for the figure to decrease, the 4-week moving average is expected to edge slightly higher. The Philadelphia Fed Business Activity Index for December is expected to show a modest decrease, while the Conference Board Leading Index for November is expected to have decelerated from the previous month. Coming a day after the FOMC meeting, none of these indicators will be of a particular importance, as the market will still be digesting any impact following the much-anticipated meeting. For more information, including technical analysis, please read the full comment on ironfx.com or download our app and get all the information you need to trade delivered directly to you. And also, follow us on Twitter, like us on Facebook, subscribe to our YouTube channel, or circle us on Google Plus to get more trading ideas. This is Sakis Paraskevov, Senior Fundamental Analyst at IronFX Global, wishing you solid trading.